In this Hurst Cycles Geek video, I'm going to be speaking about custom cycle lengths. In other words, what to do when the market that you are analyzing seems to have very different cycle wavelengths to the wavelengths that Hurst discovered 50 years ago and out of which we have built our default Hurst nominal model. I should warn you that, as with all of our geek videos, this video has a warning attached to it, and this one particularly. If you are not obsessed by the details of performing a Hurst Cycles analysis and applying that to your trading, then you are not likely to find this video very interesting. But if, like me, you are a little obsessed by the details of performing a Hurst Cycles analysis, then I hope that you will find this video particularly interesting. For the purposes of this video, I've chosen to take a look at the British pound against the US dollar. This is a monthly chart that we are looking at. And the first thing that I normally do when I load up new data is I will simply hit the big green Analyze button, which is out of sight at the moment, but I will simply analyze the data to see what Sentient Trader does with it. And Sentient Trader has performed an analysis on this data, and it has presented that analysis at the foot of the chart. You can see that we have 9-year cycle troughs over here, a displaced 9-year cycle trough over here, which raises a little bit of a question mark, because surely this is the more obvious position to place that trough. So that's our first question mark around this analysis. We then also have another 9-year cycle trough over here, which seems fairly reasonable, although it is of course very recent. And we have a 54-month cycle trough under this fairly prominent trough over here, and another 54-month cycle trough under this trough over here. So that looks fairly reasonable. The next thing that I do is I measure the lengths of these cycles. And you can see here we had 8.9 years. That is in fact an almost perfect Hurst 9-year cycle, so that looks quite interesting. But then when we move forward and measure the length of this 9-year cycle, you can see it has come out at 12.3 years. So what has happened? A 9-year cycle has suddenly elongated into 12 years. That's a little bit awkward. And let's measure the wavelengths of these 54-month cycles. This 54-month cycle, as you can see from 2010 to 2016, comes out at 77 months. That's very long for a 54-month cycle. It's not impossibly long. Hurst, of course, never actually defined an impossible degree of variation. To my knowledge, he never defined an impossible degree of variation. Because of the principle of variation, we do know that these cycle wavelengths are constantly varying. Sentient Trader, as a matter of interest, uses a very rough rule of thumb that 50% longer than nominal is too long. But even that is a little flexible, because it is more important the way in which the shorter cycles break down in the analysis. And so there isn't an absolute rule. The next 54-month cycle from 2016 to 2022, as you can see, is 70.7 months. So I'm not really very happy with this analysis, although at first glance it looks fairly reasonable. It is not really accurately reflecting the price movement, in my opinion. Let's zoom in a little bit. Of course, I'm more interested in the recent period of time. It's all very well looking back 30 years and saying, oh, well, there we had a perfect 9-year cycle. But what we're looking for is accuracy in the analysis today. That is much more important, in my opinion. So let's measure some of these 18-month cycles. And here we begin to see the cracks appearing in this analysis. We had an 18-month cycle of 27 months. That doesn't look very good to me. Then we did have quite a good M shape, as you can see, for the next 18-month cycle, and that cycle came in at 14.5 months. So we have a 27-month and a 14-month, 18-month cycle. In my opinion, it's not really working very well. When we measure the next 18-month cycle, you can see we have a length of 30.5 months. Now, it's all very well taking a look at this analysis and just saying, well, it must be good because it's been performed by Sentient Trader. But of course, I don't do that. What I would rather do is consider in a little more detail what might be happening in this analysis. there's nothing that absolutely denies this analysis. I'm just really uncomfortable with those very long cycle wavelengths. And I'd like to point something else out over here. If we take a look at this period of time here, we had 1 week. I've changed the timescale to a weekly timescale. We had 1 week where price dropped down very sharply, and then the very next week it climbed back up again. That is almost certainly what is called fundamental interaction, where news events around the world are causing tremendous volatility. And I will point out the date. That date was, of course, March 2020. I expect you all know what was happening in March of 2020. That is a trough that I often refer to as the pandemic trough. And so what probably happened in the British pound was that the pound dropped against the dollar very dramatically for 1 week, and the very next week it bounced up again. And that, in my opinion, probably means that this is not actually a valid trough, so that trough shouldn't be there at all. What is more likely the case is that the correct trough is positioned over there, which would of course move this 18-month cycle, but nevertheless I'm not really very happy with this analysis. So the first question that I ask myself when looking at an analysis that I'm not very confident about is whether it is possible that in fact this instrument is influenced by cycles that are synchronized at their peaks. And so I have also performed a peak analysis. And here is the peak analysis, and I do a similar sort of an analysis of the peak analysis as I did for the trough analysis. Here we have a 54-month cycle, which you can see in the peak analysis is 80 months long. In my opinion, that's not really right. There's something wrong with it. If we measure the next 54-month cycle, you can see it has come in at 45 months. So we had an 80-month cycle and then a 45-month cycle. And if we add those together and we measure that 9-year cycle, you can see it comes out at 10.5 years roughly. So again, I'm not really very happy with the peak analysis either. If we measure the next 54-month cycle in terms of the peak analysis, it comes out at 37.5 months. So we've got greatly varying cycle wavelengths. And I could have just cut straight to the chase by zooming in and taking a look at the cycle wavelengths presented at the right-hand edge of the chart over here. You can see those wavelengths differ fairly markedly from the average wavelengths that we are used to. 10.6 years instead of 9, 63.9 months instead of 54, 22.4 instead of 18, and so forth. And if we look at the peaks up here at the top, you can see a similar very big variation in those wavelengths. In particular, notice this 12-month cycle. So Sentient Trader has actually found a 12-month cycle, or I think that might be 12.9, so it's 13 months instead of an 18-month cycle. There's something wrong with this analysis. So in my opinion, if it isn't a matter of, well, this is an instrument that is synchronized at its peaks as opposed to being synchronized at its troughs, which is something you will often see, then we need to ask ourselves whether there are different cycle wavelengths that are influencing the British pound. So the first thing that I do when I ask myself whether that is possible is that I apply what is called an initial cyclic model analysis instead of a nominal model analysis. So what I do in Sentient Trader is I'm going to leave this as it is because it forms a very interesting reference point in my opinion. I'm going to load up another chart with the same data and perform an initial cyclic model analysis on that chart. So there is the same data. Let's change it to monthly as well. So now let's apply an initial cyclic model analysis instead of a nominal model analysis. And while it's doing that, I'll explain what the difference is. Here is the button that we use to do that. We simply click on that button and change the analysis model that is being used to the initial cyclic model, hit the big green button and perform an analysis. And so now it is performing an initial cyclic model analysis. What is the difference? Well, Hurst suggested in his cycles course that we first of all use the results of a form of spectral analysis to identify what cycles are actually active in the instrument that we are currently analyzing. And he would then build something called an initial cyclic model on the basis of the results of that spectral analysis. As a matter of interest, Sentient Trader does do this. It does this at the beginning of every analysis. When I say it does it, it performs the spectral analysis, and then there are two options in terms of performing the pattern recognition part of the analysis that Sentient Trader performs. And those choices are to give greater emphasis to the original nominal model with the cycle wavelengths as defined in the nominal model, or whether to give greater emphasis to the initial cyclic model that is built on the basis of the nominal model. I am going to have to record further geek videos to explain this difference, because that is a subject worthy of its own video or several videos. But in the meantime, you can see the results of the initial cyclic model analysis, which you must remember is giving greater emphasis to the results of the spectral analysis. As a matter of interest, I'll take a minute just to quickly show you the results of that spectral analysis. Here are those results, and they are presented in a thing called a periodogram. The first time I ever came across a periodogram was when I read Hurst's Cycles course, and I do wonder whether in fact it isn't something that he invented, but it is a way of demonstrating or showing the results of a spectral analysis. The taller the peak of these green columns, the greater is the evidence that there is a cycle of that particular wavelength active in this data. So you can see, in fact, the tallest peak over here is at about 136 days, which is interesting because, of course, the average length of a 20-week cycle is 136 days. If we double-click there, we can see the results of the analysis performed on the weekly data. And if we double-click again, we can see the results of the analysis performed on the monthly data. You can see there is quite a big peak over here, round about the 18-month point, and there's another peak over here, as a matter of interest, a little earlier, perhaps about 15 months, something like that, 14 or 15 months. So those are the results of the spectral analysis, and you can study those results. Or nowadays, there are many other very powerful software packages that will perform spectral analysis for you and extract cycle wavelengths. By performing an initial cyclic model analysis in Sentient Trader, we're handing over all the heavy lifting to Sentient Trader. So in other words, we're not having to study the results of the spectral analysis and decide for ourselves what cycles are present. We have asked Sentient Trader to do that for us, and it has done it, and it has indeed performed an analysis. So let's quickly take a look at this analysis. If we measure the distance between this trough over here, which you can see has been labeled as a trough of the 14-month cycle, then we get a trough over here at 7.5 years, and if you look at the bottom right of the screen, you can see the average wavelength of that cycle is not 9 years but about 7.1 years. So that's quite interesting. It has found shorter cycles. If we measure the next 7-year cycle, we get 7.78 years, and if we measure forward from there, we get 72 months. And so the point about this analysis is that it has found cycles that seem to match the price action a good deal better. And if we zoom in, you can see that we have, of course, a prominent trough over here, which is very nice. And we have, after a 40-month period has elapsed, we have a trough over here, which has been labeled as a trough of the 41-month cycle. Now, of course, it becomes difficult when you're looking at an initial cyclic model because all the cycle wavelengths have changed. So that makes it a little complicated. Instead of a 54-month cycle, we've got a 40-month cycle, but there's nothing wrong with that. But then we do have this rather awkward 30.2-month cycle, which is a little questionable. But as mentioned, of course, we have this, let me change the scale here to weekly, we have this pandemic trough that is happening over here. And so I would be inclined to actually position that cycle trough over here underneath that trough there, and if we measured the number of bars there, I think we might find it's a little more balanced. There we have about 34 months, and if we measure forward again, we have 38 months. So it is a little more balanced if we position it in that earlier spot. So this is one way to get Sentient Trader to analyze an instrument that doesn't seem to have the same cycle wavelengths as the default Hurst model, which is, of course, I should remind you, based upon his research done 50 years ago on US stocks. So it is quite possible that the British pound is being influenced by different cycles, and in some ways not really a surprise that the cycle wavelengths are different. But now I'm going to get really geeky in this video, and I'm going to take this this one step further. The initial cyclic model that is built by Sentient Trader is based in terms of its structure on the nominal model. What I mean by that is that the harmonic ratios between the cycle wavelengths in the initial cyclic model is the same as it is in the nominal model. So here, for instance, the yellow diamonds are, of course, what we are used to seeing as the 18-month cycle troughs. Here, of course, we have an average wavelength of 11.2 months, so just under a year. It's a very short 18-month cycle, but of course it is based upon the initial cyclic model, so the results of that spectral analysis. But the important thing here is that you can see we have one 18-month cycle, or I should call it an 11-month cycle. It gets a little complicated, I know. We've got one 11-month cycle, then two 11-month cycle, and then three 11-month cycles, and we end up with our next longer cycle trough. So in other words, we have the same harmonic ratios between those cycles. Let me quickly display the semicircles here just to make that a little more obvious. You can see that we have 1, 2, 3 yellow cycles for every one of our orange cycles, and then we have 2 orange cycles for every one of these light red cycles, and so forth. So the point is, it has the same structure as the nominal model. So the next question that we should ask ourselves here when it comes to the British pound to US dollar is whether that 3-to-1 harmonic ratio between what we know as the 18-month cycle and the 54-month cycle is applicable to the British pound. And the simplest way to answer that question, in my opinion, is simply to do a little bit of measuring on your charts, something you can do even if you do not have Sentient Trader. You can work with any charting platform and you can measure the distance between these troughs. I'm going to show you how I do this. I'm going to turn off the phasing for now so we are not disturbed by that, and I'm going to display monthly data. So the first thing I'm going to do when I start measuring for cycle troughs, and probably the reason why I do it like this is because when I started performing Hurst Cycles analysis, I was using printed charts. I printed charts out of TradeStation, and I would literally write on them with a pencil and use an eraser to rub out the mistakes. And I found that process really very useful because it gave me tremendous insight, and I think that it still does. So the first thing I do is I identify the important troughs, and so I can see an obviously important trough there, one there. I'm going to call that a pretty important trough over there as well, and I'm going to call that an important trough, and I'm going to call that one, and of course we have this one over here which I will put a question mark under. Okay, so then having identified those troughs, we measure the distance between those troughs. Now, this is very important. If you're not working with Sentient Trader, you must remember that Hurst Cycles influence financial markets in real time 7 days a week. So it's not good enough simply to measure the number of trading days or trading bars. You must measure the actual time. Most charting platforms will enable you to do that, so and that's not a big limitation to other trading platforms. So here we have 2,785 days. You can see the number below there. It's 7.62 years, but I'm more interested in the number of days, 2,785 days. And if we measure to this trough over here, we've got less than that. That's about 51 months. And then if we measure forward again, we get 2,830 days. So that's quite interesting. Of course, I'm looking at a monthly chart, so there's going to be a difference according to exactly where I clicked with the mouse. So there will be a difference of about 30 days if I accidentally click on the wrong month. The point is we're looking at perhaps about 2,800 days over there. Now, if I measure from this point forward to this trough, which so far looks like a fairly prominent trough, then we've got a number of 2,168. And if we measure back to here, we've got 1,300. And if we measure from there to there, we've got about 1,500, something like that. So I'm coming up with a lot of numbers here, and I would encourage you to do this and experiment with it. At the end of the day, we are looking for evidence of a particular cycle wavelength purely on a visual basis. And it might seem like a very rough approach, and it is, but the truth is, it works fairly well. When I am not sure in terms of which one of these yellow circles fits with what cycle, what I will tend to do is look over a range of them. So there we have 1, 2, 3, 4 circles, and you can see we have a length of 4,987. Very close to 5,000 days. So let's just for now consider that it's 5,000 days. We do not need to be accurate. Now let's take a look at the peaks, because of course the British pound might be influenced by cycles that are synchronized at their peaks. There is an obvious peak there, there's an obvious peak there, and there's an obvious peak over there. Now let's measure the number of bars between those peaks. And we can measure that first number there, 2,431. Now, of course, I am writing these numbers down as I'm measuring them. I'm not wasting your time by writing them down on the screen, but I have a little notepad here and I note down these numbers. And you will fairly soon start to see a pattern appearing when you do this for yourself. So 2,431, and we measure forward to this one over here, 2,500. Isn't that interesting? 2,500 and 5,000. We're beginning to notice a pattern, or at least I am, but perhaps I'm just one of those people who tends to see patterns in the stars in the sky. But certainly these numbers seem to bear some relationship to one another. If we measure the distance between these two more widely spaced peaks, you can see we have about 13 and a half years, but in terms of days, 4,931 days. So the numbers that really stand out to me there are a number of about 5,000. Look, I'm being approximate. You can add up a whole lot of different measurements and you probably come up with a more accurate number. But for this part of this discussion, and all I'm trying to do is demonstrate to you how to do this, 5,000 is good enough for now. And we have found several examples of troughs that are roughly 2,500 days apart. So there is a clear 2-to-1 harmonic ratio between those two numbers. So I am inclined to think that those two numbers represent two cycles that are fairly active in the British pound to US dollar. So a quick and rough calculation will inform us that that is about 14 years in length. And of course, this is about 7 years in length, a little bit shorter, I think, in both cases. That's interesting because our initial cyclic model analysis gave us a 14-year and a 7-year cycle, you might remember. So I think we might be onto something here. But the reason why we're doing this manual process instead of simply going with the initial cyclic model analysis is the big question in terms of what is the harmonic ratio of the next shorter cycle, or perhaps not the next shorter cycle, but the cycle after that. So what we're going to do is a little bit of exploring, because the next shorter cycle would be 1250, or if there was a 3-to-1 harmonic ratio, it would be about 833 or something like that. So you can see the difference with what we're doing here to what we did with the initial cyclic model. The initial cyclic model inherits the structure of the nominal model in terms of the harmonic ratio between the cycles. We are not doing that. I am questioning every part of this process. What is the next shorter cycle? So the way in which we resolve that is I will tend to zoom in, and let's change the resolution to a weekly chart, and we can measure to see whether we find evidence of cycle troughs at around about 1250 or round about 833. So here is an obvious trough at 1508, but let's measure backwards from this position over here, and you can see it's a length of 1301. What about 833? There isn't very much there. 833 is round about there. And if we measure from this point over here, it brings us to about there. I'm not seeing clear evidence of troughs at 803, but I am seeing better evidence of a trough at about the midpoint. So if we measure here, the distance between these two is 2170. Half of that, of course, is 1085. And here at 1065 is this trough over here. Let me just quickly switch back to the pen. This trough over here, which, as I mentioned, is probably the better trough as opposed to this pandemic trough. And so, in my opinion, the next shorter cycle is 1250. Now, what I would normally do is I would repeat this process all the way down to the shorter and shorter cycles, but so as to prevent this video from turning it into an epic, I'm going to stop the process here and go straight into building what is called a custom nominal model in Sentient Trader. Don't be frightened by the rather fancy name for it. It's actually really simple. So having measured our cycle wavelengths and come up with different wavelengths to Hurst standard nominal model and even different harmonic ratios between those cycles, we're going to build our own nominal model. Let's first of all load the same data into a new chart. And now the quickest and easiest way to build our own nominal model is simply to edit the model that is already on this chart, which is the default nominal model that is applied to all of your charts, which in this case is of course the Hurst nominal model on daily time frame. And I am going to rename this nominal model, and let's call it the British pound to US dollar. And I'm going to call this a 2-to-1 model, and it is of course for daily data. So in this cycle model editor, the editing process is actually really simple. The really important thing to remember is that a nominal model must be robust. It must be absolutely correct. And in the drop downs here, you can see you can go all the way down to seconds, but we don't need to go down to seconds. Going down to days is good enough. You can see that the average wavelength of a 9-year cycle is 3,276 days, and I'm simply going to replace that with 2,500. If you have calculated more accurate wavelengths for this cycle, then great, put that more accurate wavelength in there. I should point out that, of course, Sentient Trader is pretty good at dealing with the idea of the principle of variation. And so even if your cycle wavelengths are not absolutely accurate, it will do a fairly good job of analyzing on the basis of the nominal model, even if it isn't perfect. Now, of course, this is no longer a 9-year cycle, so I'm actually going to change the name of it to a 7-year cycle so that we know that we're looking at a 7-year cycle in this case. Now, you will have noticed that all these labels below that 7-year cycle went red. Well, not all of them, but for cycle number 3, the 54-month cycle, those labels have gone red, and that is because the structure of this nominal model is not correct. Never mind, we are going to fix that. And so I'm going to change this back to years, otherwise Sentient Trader will display the wavelength as days in every one of your descriptions of this particular cycle. So the name of the cycle is a 7-year cycle, and we want its wavelength described in years. You can see it is 6.84 years. Now, the 18-year cycle is, of course, no longer an 18-year cycle. It is now going to be called a 14-year cycle. And I could simply double that, but I like to go down to days just to make the cycle wavelength a little more accurate. So I'm calling that a 5,000-day cycle. But again, I will switch back to years so that the cycle wavelength is presented in a number of years as opposed to number of days. Now you'll notice we've got several red labels. Why is that? It's because Sentient Trader is working out the harmonic ratios as we go, and we don't really want it to do that. So the harmonic ratio between the 14-year cycle and the 7-year cycle is 2-to-1. So you see this label here, it says quick harmonic ratio 2-to-1. I'm going to click on that, and now this cycle has had the 2-to-1 harmonic ratio applied to it, and we end up with a 6.84 year cycle. Now what I'm going to do is the next cycle down, I'm also going to simply click on the quick harmonic ratio. You can see it's been adjusting these harmonic ratios and wavelengths as we work. The reason for that is because the nominal model tries to adjust itself to become a perfectly robust nominal model, but that's not what we want. So we need to tell Sentient Trader not to do that. And I'm going to relabel that. It's no longer a 54-month cycle, but it is a 40-month cycle. And now for our next cycle down, cycle number 4, normally the 18-month cycle, instead of applying a 3-to-1 harmonic ratio, I'm going to apply a 2-to-1 harmonic ratio, just to demonstrate to you that it is possible. You can play around yourself and explore different harmonic ratios if you like. And this is no longer an 18-month cycle, but it is pretty much a 21-month cycle, so I'm going to do that. And I'm going all the way down the nominal model, and I'm simply applying a 2-to-1 harmonic ratio to each one of these cycles. You can see we can still call the 40-week cycle a 40-week, even though it's probably closer to 45. The 20-week is 22 weeks. I'm happy with that. the 80-day cycle now has an average length of 78 days. Isn't it interesting how you build these nominal models, and in fact you find that the shorter cycle wavelengths that we're really familiar with are often very similar between the different models. But what we should find when we perform an analysis using this particular nominal model is that we get a more accurate description of the price action through the cycle analysis, and we're going to demonstrate that in a moment. Now, I have created a new nominal model here, so I click on the Save as New button and just give it one final check. I've got no red labels, my harmonic ratios are 2:1 all the way. I'm feeling fairly good about that, so I'm going to save and close. Now, on this particular chart, I'm going to assign this nominal model to this chart. It is the British pound 2:1 nominal model. I've assigned it, and now I click the big green button, and CentiTrader will perform an analysis using that nominal model. I'll pause the video and we'll take a look at the results of that analysis in a moment. And there are the results of the analysis. We have a 14-month cycle trough over here, a 7-year cycle trough here, 14-month, and then another 14-year, I beg your pardon, and then another 7-year cycle trough over here in 2022. You will notice, if you take a look at the analysis or at the cycle wavelengths, that the cycle wavelengths that have been found in this analysis are actually almost identical to the cycle wavelengths that were found in the initial cyclic model analysis. But there is one very important difference, and that has to do with the harmonic ratio between what used to be the 18-month cycle, but is now, of course, about a 14-month cycle. And that difference is that we do not have a 3:1 harmonic ratio. We have a 2:1 harmonic ratio because there are two of those yellow cycles. Let's display the semicircles again. There are now only two of those yellow cycles for each one of these orange cycles. Only two yellow cycles, one orange cycle, and of course 2 orange cycles for a red cycle, and so forth. So we are working with a fairly different nominal model because of the different harmonic ratio between the cycles in that model. Now we can explore this analysis and we can delve into the greater details and see what is happening. But before we do that, I'm actually going to add a peak analysis onto this chart, because the interesting thing about this nominal model that we have created is, as you will remember, it relates very well to the peaks as well as to the troughs. And there is the peak analysis at the top of our chart. We have a 14-year cycle peak over here in 2007, I think that was. We have another 7-year cycle peak over here in 2014, and the next 14-year cycle peak was this one over here in 2021. Now, the interesting thing about this peak analysis is that as we zoom in, you will notice, I think, that these 18-month cycle peaks, although of course they are 14-month cycle peaks, work very well. And I rather rushed through the consideration of whether there was a 3:1 harmonic ratio or a 2:1 harmonic ratio between those cycles earlier in this video. But in the peaks, I think it is fairly clear that a 2:1 harmonic ratio works better than a 3:1 harmonic ratio. And so you can see evidence of that here, particularly in the peak analysis. So that is how you perform an analysis with different cycle wavelengths. There are some ways, of course, that we can very quickly assess this analysis and whether the analysis is better than the earlier analysis that we were looking at. One way of doing that is to simply add a composite model line. If we add a composite model line based on both the trough and the peak analysis, you can see that the composite model line matches price action in the past very well. And the reason why it does that is because we have refined our nominal model to reflect the cycles that are, in my opinion, present in this particular instrument. And so the composite model line gives me increased confidence in this analysis and in this particular collection of cycle wavelengths. The interesting thing is that it is not looking very bullish for the British pound. So before we simply accept that, I should point out the fact that this trough has been phased as a trough of 7-year magnitude is something you would probably want to question. You would want to ask yourself whether in fact this 14-year cycle trough might have formed over here, which would then of course give us a much more bullish move out of that trough and give us a very different picture. So that is something you would want to explore on your own. I'm not going to waste time in today's video doing that, but let me show you the other way in which we can gauge the accuracy, if you like, or the appropriateness of the cycle analysis that we have. I'll switch back to a monthly chart and I'm going to apply the zigzag tools. Now the zigzag tool can only be used when you have a dual analysis, both a peak and a trough analysis, but when the zigzags are fairly accurate, it tells us that we have a good and well matched analysis between both the peak and the trough analysis on the chart. So here I have plotted the zigzags for the 7-year, I must try and remember the cycle wavelengths here, for the 7-year cycle, the 40-month cycle and the 14-month cycle, I think it was. And if we take a look at the statistics up at the top right, which you can plot on your chart, the important thing here are the valid percentages. You can see that 85% of these 14-month cycle zigzags were valid, 100% of the 7-year cycles, 92% of those 40-month cycles. So that's a very high valid percentage. So that again tends to increase our confidence in this analysis. There are other ways of gauging the effectiveness of the analysis. For instance, we can look at our phasing information presented in this box over here. So this phasing information presents numbers, if you like, about the analysis that has been performed. Of particular interest are the fact that 96% of VTL crosses correctly confirmed the cycle troughs, and 85% of FLD confirmations were correct. There's only a 10% deviation from nominal, and the cycle regularity is 69%, which is not very high, but nonetheless those numbers are good. So there we go, we have an analysis of the British pound to US dollar performed using different cycle wavelengths, different from Hurst's default nominal model. I do hope that you found this geek video interesting. Please let me know if you have subjects for future geek videos. I already have a list of almost 10 videos that I hope to be producing soon. And of course, if you have any questions, put them in the comments below this video or join us on our Hurst Cycles Discord channel.